What is a related party transaction? Hello everyone, I am CS Avil Rakshith Salins, Company Secretary by profession. Welcome to my channel Corporate Clarity, where we discuss important topics in corporate governance. Today, we are going to talk about related party transactions and their regulations in India. Related party transactions refers to transactions that occur between two parties who have a pre-existing relationship or connection. These parties could include individuals, companies, or entities that are somehow linked, such as through common ownership, control, or influence. Section 276 of the Companies Act 2013 defines related party with reference to a company, which means 1. A director or his relative, 2. A key managerial personnel or his relative, 3. A firm in which a director, manager or his relative is a partner, 4. A private company in which a director or manager or his relative is a member or director, a public company in which a director or manager holds along with his relatives more than 2% of its paid-up share capital, any body corporate whose board of directors, managing director or manager acts according to the advice, directions or instructions of a director or manager. 7. Any person on whose advice, directions or instructions a director or manager is accustomed to act. So who are considered as relatives? Section 277 of the Companies Act 2013 defines a relative with reference to any person as anyone who is related to another if they are members of a Hindu undivided family, their husband and wife. One person is related to the other in the following manner: father, mother, son, son's wife, daughter, daughter's husband, brother, sister. Are related party transactions permitted under the law? Yes. Related party transactions are permitted subject to regulations. How are related party transactions regulated in India? Related party transactions in India are primarily regulated under the Companies Act 2013 and the Securities and Exchange Board of India regulations, Income Tax Act 1961 and the Reserve Bank of India regulations. These regulations aim to ensure transparency, fairness, and accountability in dealings involving related parties. In India, related party transactions are closely regulated to prevent conflicts of interest and protect the interests of shareholders. The regulatory framework involves multiple layers of approvals, stringent disclosure requirements, and penalties for non-compliances. Companies must ensure these transactions are conducted transparently and at arm's length to maintain corporate governance standards and uphold shareholders' trust. Potential misuse of related party transactions. Related party transactions, if not properly regulated and monitored, can lead to several forms of misuse. The main concerns revolve around conflict of interest, unfair advantages, and potential harm to the company and its shareholders. Here are some of the key misuses that can arise. 1. Conflict of interest. Favoritism and nepotism. Decisions may be influenced by personal relationship rather than business merits, leading to unfair advantages for related parties. Compromised objectivity. Directors or key managerial personnel might prioritize personal gains over the company's best interests. 2. Financial misappropriation. Asset stripping. Assets of the company can be sold to related parties at undervalued prices, leading to asset misappropriation and loss to the company. Inflated prices. Goods or services can be purchased from related parties at inflated prices, diverting funds and reducing profitability. Earnings management. Profit shifting. Profits can be shifted to related entities to manipulate financial statements, either to show higher profitability in a related entity or to reduce taxable income. Expense manipulation. Expenses can be artificially increased through transactions with related parties to reduce reported profits. Unfavorable contract terms. Disadvantageous agreements. The company might enter into contracts with related parties that have unfavorable terms, such as higher interest rates on loans or less favorable credit terms. Long-term obligations. Entering into long-term contracts with related parties can lock the company into unfavorable terms for extended periods. Circumvention of regulatory requirements. Bypassing tender process. Related parties can be awarded contracts without following competitive bidding processes, leading to inefficiency and higher cost. Not compliance with governance standard. Bypassing internal controls and governance standards to favor related parties can lead to regulatory non-compliance. Impairment of minority shareholders' interests. Dilution of minority stake. Transactions with related parties can result in dilution of minority shareholders' stake or interests, adversely affecting their value. Expropriation of wealth. Majority shareholders or those with significant influence can use related party transactions to expropriate wealth from the company, harming minority shareholders. Reputation risk. Loss of credibility. Persistent misuse of related party transactions can lead to a loss of credibility and trust among investors, customers, and other stakeholders. Regulatory scrutiny. Misuse can attract regulatory scrutiny, leading to investigations, penalties, and legal consequences, further damaging the company's reputation. Examples of potential misuse scenarios. Insider trading. A director uses confidential information to engage in transactions with related parties, gaining an unfair advantage. Loans and guarantees. The company provides loans or guarantees to related parties on terms that are not at arm's length, risking financial stability. 3. Excessive compensation. Unjustifiable high components or perks are given to related parties, draining companies' resources. Transfer pricing manipulation. Prices of goods and services are manipulated to benefit related entities, impacting the company's taxable income and overall financial health. Mitigating misuse. To mitigate the risks associated with related party transactions, companies should adopt the following practices. Robust internal controls. Establish strong internal controls and procedure to ensure that transactions are conducted at arm's length. Independent oversight. Involve independent directors and audit committees in the approval process to provide unbiased oversight. Transparency and disclosure. Ensure full transparency and disclosure of related party transactions in financial statements and reports. Regulatory compliance. Adherence to regulatory requirements and best practices to minimize the risk of misuse and maintain stakeholder trust. In the coming videos, I will dig deeper into the explanation and provisions of various related party transaction regulations in India. Stay tuned and subscribe to the channel. Thank you.